Great. So come once again to the question solving stage of IAS 12. We call it what? Income tax. IAS 8. Please, if you want to get a full picture, kindly visit the tutorial video. This is the question solving stage. So IAS 12 basically explain or inform how the income tax of a company, income tax expense will be arrived at or will be calculated or will be accounted for. So the income tax expense you see in the company's financial statement, income tax expense that you see in the company's financial statement, how do we arrive at such figure? Or how do we recognize it in the financial statement? In summary, we said that the income tax expense that you see in the financial statement is made up of three items. CUD. Good. So if you pick income tax expense for every company in their financial report, the annual report, the income tax expense that they've recorded or they've recognized or recorded in the financial statement, how they arrived at that figure. That's all about the IAS 12. Good. The C, this is acronym CAD. The C represents what? Current year tax provision. So current year, recap. Current year tax provision. So much. Then you relax. Let's bring our Ghana city here. The C, we can also call it corporate tax provision. Corporate tax provision for the year. That's another name for it. Corporate tax provision for the year. Then the U or the O is under or over tax provision. Under or what? Over. So let's say under slash over tax provision. If it is under, don't worry, relax and add it. If it is over, subtract. So that is it. So under you add, over you subtract. Then the D is the movement in the deferred tax. So movement in what? Deferred tax. So that's the deferred tax. Good. So much. Putting this together is what we refer to as the income tax expense for the year. And this is what we are going to show to the P&L. Taking to the profit and loss as what? P&L as income tax expense. That's the figure. So now your tax is, you should know how you calculate these three items. You are done. Some of them are free. The first two are not too difficult, but the last one is the troublesome guy. But don't worry, you'll be fine. Now, current year tax provision. How do you arrive at that? Now the question is, we are preparing a financial statement. We're supposed to wait for GRA, the tax authorities, to tell us what the right tax that we're supposed to pay so that we can include that one in, right? Meanwhile, the tax authorities is also waiting for you, for them to scan your financial statement and determine your tax liability. Now who's wait for his friend? So now the law will sit down and wait quietly for you because the law will have the final say. Now, so it means that we have to prepare our financial statement and then send to the GRA or the tax authority for them to scan through to tell us our tax. So you have to make a provision, estimate. So provide, do a guesswork for now. So they will confirm it for you afterwards. They'll confirm the right tax. So that's why we call it current year tax provision. It's a provision because not the actual. Because we don't know, the law does not allow us to determine our own tax. You can't determine your own tax, no. Other than tax no dey we pay once, right? If you say you should determine your own tax, some people will not pay tax. If they allow companies or they allow individuals to determine their own tax, trust me, only few people will be honest. Only few people. Only few people. If not because of this, God will not even bring the Malachi. Chapter 3, verse 10. Even tight where God is not there. Look at how sometimes you cheat God. Good. So that is how it is. So make a provision when they tell you your final tax, then you reconcile the difference. So now the issue is how. In the financial statement preparation, two places in which they'll give you this figure. One, it has to be in a trial balance. If it's in a trial balance, if it's given to you in a trial balance, the name will change slightly. They will call it tax computed on what? Taxable profit. So if it's in a trial balance, we call it tax computed on taxable profit or income tax expense for the year. If it's in a trial balance and it will be at debit side, notifying you that it's an expense. How we get it? Good. And it ends there. Once it's in a trial balance, when you bring it here, the treatment ends there. No any other treatment again. After you bring it here, it ends there because the item in the trial balance must be treated what? Once. Good. What if it's in the footnote or the additional information? Additional information. That one they will use these terms, current year. So if it's in the footnote or the additional information, treatment must be 2, 1, and 2. 1, you add it to the income tax expense, what you've done here, after adding it here. So income tax expense, so add it to the income tax expense, no shortcut mechanisms. Good. Then, have you paid for, no, it's a provision. And then provisions are what? On certain, their liability of what? On certain timing and then amount. So their liability. So add it to your current liability because it's not paid for. Add it to what? The current liability. You are done. So if they've given it to you in a footnote, just add it to what? Your current liability. And then you are done. Good. Now let's see. Now let's move on to the under or the over tax. Under or over tax. So with the under or over, we said that the current year tax, it's a provision. So every year we have to do what we call tax reconciliation. That means we have to reconcile the difference between what you provided and what the tax authority agreed on, the final tax liability. Good. So that is it. Because
Fred, you said it's in the trial balance as well.
now let's see. Now I'm done with the current year tax. Let's go to the under or over. This one is recap. Summary. Summary. Now The current year tax provision is an estimate, so to be confirmed for you by the tax authority. So when they confirm it, either to be more or less than what you provided. So do the reconciliation. So now let's assume that, and it's always for the previous year. In fact, it's for previous year because they can only confirm the previous year for you. You are now preparing the current year financial statement. So take notes. Sometimes the examiner will use dates. They will not inform you that this is the previous. No, they will use date. If I am preparing the financial statement for 2019, then I can only get under or over for 20 what? 18. Because by then they've confirmed the 2018 income tax liability for me. 2019, I am now preparing it, so they will not confirm it, or they have not confirmed it for me because I have to submit the financial statement to them before. I am now even preparing it, and then auditors come and audit it before I will submit it. Good. So to be confirmed 2020 there. So take notes. So this is what you do. You compare two items. Tax provided. Tax what? Provided so much versus final or agreed tax or tax agreed. Final or agreed tax. Agreed by who? The tax authorities. Good. Agreed by the tax authorities. So if you compare this and what you provided is more than is what over provided. If you provide what you provide is less, under provided. If it's under, you add. Under means the tax that you provided was less. So come and top it up. So it's an additional expense to you. Because whatever you provided is less. But if it's over, then it's a plus for you, it's a gain for you. That means subtract it from your tax that you are going to pay or your tax that we are recording in a financial statement. Now let's give ourselves an example. Assuming that the tax provided is 3,200 and final tax agreed is 4,000. So will it be under or over? Tax provided 3,200, tax agreed under, right? So it has been under provided by what? 800. They call it under tax provision. So you come and then write it here and you add to your income tax expense for the year.
The difference.
Yeah, the difference. The difference of what? The 800 is the under tax provision, which must be added to the C. Then you add the D to it, then you are done. So 3 items. Good. Now let's see. If it's the trial balance, under means an additional expense, so that's what we're adding. And you know expenses have what balance? Debit balance, right? So sometimes the examiner will perform this calculation for you and just reflect this 800 because it's as a result of last year, it's a balance. Because last year it will be in a trial balance, so it's a balance. So if it's in a trial balance, they will not tell you it's under or over. No, not at all. When you do that, when you do that, we solve the question for you. So what they will inform you is that current year tax 800. You have to use the balance to determine whether it's what? Under or over. You know that under is an expense, and expense have what balance? Debit. So if you see it at debit side, it's what? Under. If you see at credit side, it's what? Over. So if it's at the credit side, it's over tax provision because all gains have what balance? Credit balance. All revenue have credit balance. All gains have credit balance. All income have credit balance. So over tax provisions are what? It's a gain. It's a plus for you. So it must have what? Credit balance, and then you are done. So that's fine. Good. So that's the end of the first two. So I gave a trial. So I'll produce some question and then ideally you solve it for me as usual. The question has been solved in the very first video, the tutorials. So I may not repeat that question again because in the first video. Good. So I think I will solve extra. Then let me explain the deferred tax so that any question that we pick, we can do justice to it. Good. Now you can use the first video to get the explanation of deferred tax. We are going to work. We are going to consider the working of the deferred tax. Good. Now the deferred tax is the movement. This is the movement. So what you do is you open a separate workings again and call it what? Deferred tax. Deferred tax workings. You compare two items, you are done. Compare the open balance so much to that of the closing balance so much. If the open balance is not equal to the closing balance, the difference is the movement. You are done. It ends there. So this figure is not difficult at all compared to items. Open balance, closing balance. Now the issue is this. The difference between this and this goes to the P&L, and that's the deferred tax movement. It's like a balancing figure. It's a balancing figure. So you write it here. And this is the figure that you are going to what? Record it where? Here. How we get it? That's the figure. So as it is here, the same amount carried there. Don't change anything. So the same figure that you are presenting it there. Good. So let's assume that here is 50 series and the closing balance is what? 55. What will happen? Now what you do is this. Here becomes 5, right? So that means you have to the deferred tax movement will be what? Will be 5. What if here is 40? Then you have to reduce by 10, right? Deferred tax reduced by 10. So that means over there will be 10. Here will be what? Negative 10. Put it in brackets. But then as it is the same as we done to the other hand, then you are done. Now the issue is that this closing balance sometimes will be non-current liability or non-current assets, depending on the temporal difference, resulting the deferred tax. So that is it. Now, how this open balance will be given to you in a trial balance, so don't need to worry. The open balance will be in where? The trial balance, so don't need to worry about it. Open balance is always in a trial balance. Now, what you have to worry about is the closing balance. That's one you have to work for yourself. It's in a footnote. Or we can also inform you the movement. That means if you add these two together, then you get the closing balance. But that one is not the usual one. The usual one is that open balance will be given to you, closing balance will not be given. So open balance will be given to you in a trial balance, but the closing balance will not be given to you. So you have to look for it. Good. So that is it. Great. So the movement. Now, how do you find this closing balance, this figure? This figure is the temporal difference multiplying by what? The tax rate, the temporal difference. In fact, I'm not explaining deferred tax here because I'm assuming that you're going to use the full lecture video. I think it's about an hour. Within an hour, you are done. it will explain more about the deferred tax. But we did more there. So that today we go straight and solve the question. So if you understand the question, fine. Good. Now, deferred tax is an accounting measure, not legal measure. So that's one fact about it. That means it means that legally there's no deferred tax. It's in accounting books. Good. There's no law that talks about deferred tax. Good. Now the closing balance is nothing but the temporal difference times the tax rate. That's all. That's all. So the question is, you have to know how to find or how to calculate what the temporal difference. Then you are done. So when you get a temporal difference, then you relax. Then you multiply by the tax rate given to you. That's the deferred tax provision at the end of the year. Good. So that is it. So now what is temporal difference? What is temporal difference? In fact, temporal difference is difference between two items. Just compare two items and find their difference. What then? So the difference between the carrying amount of an asset or a liability and its what tax base. So that's the temporal difference. Now let's work on it. So temporal difference is what? The difference between the carrying amount of an and asset or liability and its what tax base. So that is the temporal difference. The difference is what? Temporal. It's not permanent. So here, all what you have to do is this. You compare two items. So carrying amount, I also call it book value. How the accountant see the item. It's also called carrying amount. Carrying amount. It's also called accounting base. Wow, one word. Accounting what? Base. You compare versus the tax base. Good. So to get a temporal difference exists in two items. Asset and liability. These are the only two items that create what? Temporal difference or deferred tax. How do you get it? Good. Now, so if I have an asset and then the carrying amount or the book value or the accounting base is, let's say, 500 Ghana cedis. But the tax base is what? 280 Ghana cedis. So what is the temporal difference? Temporal difference is the difference between these two guys. You are done. Have you get it? So here the difference will be 220. So that's the temporal difference. So if you know the tax rate, you will strike it on the temporal difference. It will give you what? The deferred tax provision, and you are done. So that is the calculation section. Good. Now, this temporal difference, there are two types. It can be taxable or deductible. The rule is saying that if the accounting base, if the item in question is an asset, and then the accounting base is what? Greater than the tax base, then it will create what we call taxable temporal difference. If the item in question is an asset and then the accounting base happen to be the more or greater than that of what the tax base, we have a special name that we call such temporal difference. Such temporal difference are called taxable temporal difference. So they are what? Taxable. Mean that the tax man will call you in future and tax you. Good. So that is it. The reverse is true. And taxable temporal difference. So temporal different, the type. So taxable temporal difference means non-current liability. So in that instance, the balance carried down of the deferred tax must be stated as non-current liability. We call it deferred tax what? Liability in the financial statement. So that is it. Good. Now the reverse is true. Okay. Book value and then the carrying amount, tax base. It's like this. For accounting purposes, what is the value of the asset? Okay, the value of the asset for accounting purposes. Now, applying the accounting rules. What are the accounting rules? IFRSs. So you are going to use IFRS to determine the value of your assets. Taxman will not use the IFRSs. Taxman will use what? The tax laws to determine the value of the same building. Yes. So the accounting base and tax base is how the taxman sees that building and how the accountant also sees it. They are different. Even though they have the same eyes, but the spectacle that they're using are different. So we see different items. One uses the IFRS as spectacle, one also uses what the tax laws as what as spectacle. Good. So it will create a difference. However, this difference is temporal because if the asset is alive, then there will be difference. As soon as the assets vanish from their books, there will not be different. Let's assume that the life of the assets is, let's say, 20 years. Taxmen said no way, this one must last for 10 years. That's why their value drop huge. But here their value does not drop because they will spend long years. If I give it matter of time, 10 years time, it will be off from the books of what? The taxman. The taxman was capital because that's what after 10 years. But the accountant, after what 20 years, the accountant too is capital. So it means that in the 21 years time, nobody records that item as an asset. So it has vanished. So that difference was what? Temporal, not permanent. But if you want the full version of this, use the first video and then you'll be fine. That's good. So that is it. So now compare two items. The if it's an asset, compare if the carrying amount or the tax base is more or greater than that of the tax base, then it is what? Taxable. And if it's taxable, it's non-current liability. That means the balance carried down will create a non-current liability. The reverse is called deductible. If the accounting base rather is what? Lesser or less than the tax base. So we call it what? Deductible. So in that case, we call it what? Deductible. Deductible. That means in future, the tax authority will subtract it from your what? Your income tax expense. So which is a plus for you. Wow, you do have a plus. So deductible. Deductible. That one is what? Non-current assets in a financial statement. So that means the closing balance you want a non-current asset. So that is the deductible. The closing balance is what? Non-current assets. Good. The closing balance is non-current assets. Great. We said two items ready deferred tax. The next item can be a liability. Only asset and liability create for deferred tax. If you should know only one, there's no space for you to copy all this. So if you know the very first one, if you turn it upside down, it's true for the inverse. So let's see. If it's an asset and the carrying amount is more than the tax base, it's taxable, which is a non-current liability. Good. Now, if the reverse, the current amount rather is lesser than the tax base, then it becomes what? Deductible. What if it's a liability? If it's a liability and the current amount is greater than the tax base, it is the opposite of the first one, right? Good. So that will be what? Deductible. So if it's a liability and the current amount is more, it becomes what? Deductible. If it's an asset, it is what? Taxable. If it's a liability, it will be what? Deductible. Then if it's a liability and then the accounting base is rather lesser than that of the tax base, then it becomes what? Taxable. That is the reverse of what? The second one. You are done. So there's no need for you to get all this. Just one, the first one is okay for you. And most of your question will be a deferred tax liability. Yes. So that is it. And that's the end of the game. So now let's start the question solving. Now your first assignment is define deferred tax. Define deferred tax and then they state the importance of what? Deferred tax. You can get the answers from the first video. So that's the holiday assignment. Define what? Deferred tax and state the importance of the deferred tax. I get this is a past question that I'm reading. A past question I'm reading. So that is it. I'll pick my first illustration. We are going to go to these illustrations and then you are fine. Now let's go to the illustrations. Then you are fine. Okay. So illustration 1. Illustration 1. Illustration 1. If you do have the handouts, so illustration 1. This illustration has been solved in the first video, so you can check that one for the solution for this illustration. But you can try it. It's explained under over, so you can try it for us. Okay, illustration 1. An entity acquires a new computer for 1,200 in the year. So the cost of the computer is 1,200. The entity depreciates computer equipment over 3 years in accordance with what IAS 16, property, plant, and equipment. Local government provide a tax incentive to businesses for investment in new computer equipment, and therefore the full cost of the equipment is allowed for tax purposes. So here, that's the end. It's illustration, so normally we ask the question and answer by ourselves. So let's go to the board. Now in sum, we are saying that the company bought computer. The cost of the computer is 1,200. Life, useful life of the computer, 3 years. This is the book, company details. So it will help you to get the book value or the book value at the end of each year. Then let's go to the tax section. Tax. So the computer, they also see it as what? Computer. Because if you have computer, the tax man will not say this is what? YAM or calculator. No, it's still computer. How you get it? The value to it, if not dispute about it, sometimes they can challenge you with the value. Yes. Now they are saying that this computer should have only 1 year. The life is 1 year. They are saying no way this computer should have 1 year life. Meanwhile, you have 3 years life. So it will create what you call temporal difference. So now let's see, within the 3 year period, now let's see. We are just going to assume that the tax rate is what? 25% or even 30%. So I'll do the illustration. We are going to calculate the accounting base and then the tax base by ourselves. And then we find for the deferred tax provision. So quickly, accounting base here, tax base here. So for year one, what is the cost of the assets? Accounting base, under accounting base, the cost is still what? Ghana cedi of 1,200. What is the accumulated depreciation? Let's calculate depreciation. Depreciation. There, in a company's books, they are going to use for how many years? 3 years, right? So the first year depreciation will be what? 1,200 divided by what? 3. That will give us 400. Good. So what's the carrying amount? 800, right? So at the end of the year, the carrying amount is 800. See, chartered accountant, come again. So that's what? 800. Then what about the tax base? So the value of the asset for tax purposes is still 1,200. They will not accept depreciation. Tax man depreciation is called capital allowance. So they got what you call capital allowance. And they are saying the full amount, the entire amount must be granted to you in the year of purchase. So let's see. Let's confirm that statement. The local government provide a tax incentive to businesses for investment in a new computer equipment, and therefore the full cost online word is what? Full cost is allowable for tax purposes in the year that is what purchased. That's it. So the first year, full cost. So the entire one. In fact, taxman depreciation. Capital allowance is called taxman for depreciation. I'll take it off. So what's the written down value? They will call it written down value. 0. Yeah, done. So what's the temporal difference? So therefore, temporal difference is the difference between what? How the accountant value the item and how the taxman also value what? The item. So therefore, the temporal difference is what? 800. Agreed. I'm just assuming that the tax rate is what? 25%. So if the tax rate is 25%, what's the deferred tax provision? So therefore, deferred, but let me do that one at the extreme end there. That we use here for the 3 year period. Good. Good. So therefore, the deferred tax will be the 800, which is the difference times 25%. Please, I'm just assuming that the tax rate is 25%. So that will give us 200, right? Cool. So that's the deferred tax, 200. Now let's go to the year 2. Year 2. Year 2. Accountant will still have cost of 1,200. What will be the accumulated depreciation? 800, because the multiple depreciation for a year by 2, right? Good. So get 800 as depreciation. What's the carrying amount? C, 400. Good. Now, what about the tax base? Don't even worry yourself. The written down value is what? 0. Capital allowance 0. Written down value carried down 0. For those who have done tax before, don't need to worry. You don't need to know tax before you can solve this, because you're not assume that you've not done tax. And besides, tax is what? Paper 2.6. This one paper 2.1. So that is it. Good. So still, what's the temporal difference? 400. So let's go. What will be the deferred tax? The deferred tax at the end of the year will be 400 times what 25%, and that'll give us 100. Good. What about last year? Who can calculate the last year for me? What will be the temporal difference for last year? So year three, cost to cost to be what? 1,002. Accumulated depreciation be what? 1,002. So therefore, carrying amount 0. Tax bill 0. Temporal difference 0. How we get it? Good. So this is how we calculate it. Just that in the final question, that's in publication, we don't have time, or you don't need to go through all this for publication. For publication, it's just for 1 year. So kindly put it down, then I'll do the deferred tax calculation. Kindly put it down, then I'll do the deferred tax calculation. Kindly put it down, then do the deferred tax calculation. Let me know when you're done copying. Then continue the game. Good. It's either than a no question for me, right? Good. Yeah, I know that you'll be fine. Hey, trouble. Hmm. Camera is low battery. Hmm. Oh, sorry. Yes.